Looking at global markets for November, it was an incredibly strong month for investors. We had the global equity index rallying close to 8% and now extending that rally we've seen off the lows in October to around 15%. What investors were really encouraged by during the month were two key developments. The first one being on inflation. Out of the US, in November, we had the October CPI print, and this was a lower CPI number than what the market was expecting. Effectively, the market is now questioning if inflation has truly peaked, and if this would soften the stance of central banks, would we start to see these rate hikes slow down and potentially not go as far or as high as what originally expected? We also saw some evidence that the economy is starting to weaken. Numerous layoffs from very large companies, and even Target coming out and saying that they're seeing a meaningful slowdown in spending, but also seeing the crime or thefts in their business increase more than 50% year over year versus the prior year. So effectively increasing signs that consumers are feeling the pinch. And for investors, this means that this economic weakness that central banks are trying to engineer might be upon us and could start to see these rate hikes slow down sooner. Also, during the month, we had very positive developments out of China. The two key areas that investors were focused on being the COVID reopening, but also the incredible weakness they were feeling in their property market. We had the policymakers come out with a meaningful number of new measures towards both of those, and we saw China equities respond very positively. The MSCI China Index up 29% during the month, which is the best month for China equities we've seen in over 20 years. All in all for the index, this means that we saw all sectors and all regions rise. However, the best two performing sectors were more cyclical in nature. We had materials rise quite significantly, particularly due to the increased sentiment towards metals demand if China's economy does reopen, but also the real estate sector. Given a lot of the key developments out of China were in property, we had a lot of Chinese property developers rally very significantly, some of them almost as much as 200% in a single month. In terms of the sectors that didn't do so well, to really break the trend of this year, we had energy as one of the worst performing sectors, despite still providing a lower positive return. And what we're starting to see is the price of oil pull back over recent months. So during November, the price of oil was down a little more than 10%. Regionally, this meant that Latin America, which had previously been a beneficiary of these high oil prices, was one of the weaker regions, but then it was Asia that really delivered the more significant returns during the month, particularly as this sentiment in China has increased markedly. So following this sustained rally, we've seen equity markets now fall calendar year to date around 15%. Where that leaves us looking out into next year is equity market valuations trading around average levels, but still with the uncertainty of what this recession looks like next year, but also the downtrend and downgrade to earnings. And we haven't really felt either of these yet. For us, that means we believe it pays to be a little bit cautious at these levels and really wait for further data points that gives us an insight into what both of these will look like.